Hello, everyone. Welcome to the fifth and final session of the Venture Capital Bootcamp organized by ESEL IIT BHU. Today, we have a very special guest who is none other than Tej Kapoor, the managing partner of Bootcamp Ventures, one of the leading VC firms in India. Tej Kapoor have been in the VC industry for over 15 years and have invested in several startups across various sectors, from e-commerce, logistics to B2B information industry. He has worked in various geographies, including USA, India, China, and UK. We're keen to invest in exciting early and growth stage technology companies. He is passionate about solving Indian problems with technology and supporting founders who have a dream to change the world. Please join me in welcoming Tej Kapoor to the session. Sir, over to you.
Yeah, hi, hi everyone. Nice to meet everybody, and hope you're enjoying holidays in your towns. And I'm excited to be here and this session. Um, I'm just getting on my laptop actually, so just give me a sec. I think I can join from there.
Great. So, yeah, so like, how do you want to cover this? Do you want to just do like a Q&A, or how would you like me to
So
cover?
the
Like,
usual format is like you pass on the information for like 1 hour or so, and then there will be a 30 minutes Q&A.
uh, so I need to like talk for an hour.
Like an hour for max, but like
Okay,
if your
okay.
content is, yeah,
Okay, so
depends.
one second. I think you had shared certain questions, right? So maybe I can cover through that. Let me see. Okay. What is VC portfolio and what is the need for it? Okay, so I think so you guys all understand the venture capital industry, I'm assuming, or you want me to cover that as well?
Yes, sir, but it would be better if you could give a basic outline and then start with the
Okay,
concepts.
okay, sounds good. So yeah, so venture capital industry is I think it was basically the genesis was in the US, where it was quite popular to fund tech startups, and it kind of started with Sequoia being the leader in it in the valley, and a lot of high scale businesses were getting funded in the US. And that's how the whole venture capital industry started. Basically, the idea for venture capital companies is to actually back disruptive ideas, which are businesses which can scale much faster, um, and uh, and can generate more returns than a stock market would give, right? So therefore, the venture capital industry kind of came to formation. What happens is that how a venture capital fund is established is that you have a bunch of LPs, which are limited partners, who put money into a pool, and through that pool, the money is invested in various companies, and the founders come up with like business plan to explain their ideas. And I think the tech universities play a very important role, because a lot of these disruptive ideas actually the genesis of them come out of tech university. So if you see in Stanford, there is a very good ecosystem that has been built, where a lot of the Stanford graduate, come out with some ideas. And there is a road called the Sand Hill Road, where all the VCs are there, from Klein Perkins to Sequoia to, Lightspeed, etc. And all these venture fund guys, it's very informal kind of settings, in which the founders meet the venture capitalists, and they discuss their ideas in a coffee shop, or in the college itself, where they listen to their ideas and say, okay, this is interesting idea, we can fund this. in which the TAM, there's something known as TAM. I don't know if you guys know it's called the total addressable market. So the TAM becomes very important. There are like the four T's. One is TAM. Second is technology. What technology are you using to disrupt this market? Then the fourth is team, because in any company, the team is the most important. The team is the most important thing, because as the businesses go through various cycles, things may change. There could be ups and downs, but the team has to stick together. So a lot of time we look at co-founders who would have gone to technology school together, or would have gone to a business school together, because then we know that they know each other for a long time. There is a high degree of sort of liking as well as trust with each other, which is very important. About 70% of businesses, the startups fail because of founder conflict. So that's why it is very important. It's almost like a marriage, right? When you are getting into doing a business with someone, so the partnership has to last. So that becomes an important criteria for us to kind of look at it, and evaluate the business, right? Um, so I think these are some of the things which are important as we are looking to fund a company. I think the idea of a VC fund is that you invest in a bunch of businesses, and because there is always a risk, so we don't do one kind of business. Like, you invest in various, you cannot do one investment in a VC firm and think that's going to succeed. So you have to create a portfolio of investment. So every venture fund partners sit down together and they figure out, what is our strategy that's going to be to create this portfolio. Certain venture fund, that's called the venture fund thesis. Like, what is your thesis of your fund? So there are certain funds, for example, who would just focus on deep tech. There are certain funds who would just focus on, uh, let's say, consumer businesses. Like Fireside is a good example of that, where they only do D2C, direct to consumer businesses. There are certain funds which are horizontal, like Ivy Cap is a horizontal fund. So we do all sectors, but we are anchored on technology. Like, there has to be some technology, some disruption. Also, we have done definitely. Also, we have done many brand investments as well. So the venture fund idea is to have multiple businesses, not one business, because the invariably there are some businesses that will do exceptionally well, which are called like the breakout companies, um, and some businesses which will do average, and some businesses that will do below average or will die, right? So it's always a mixed bag. So if you are in a venture fund, you have to create a portfolio, and obviously you want each and every one of the companies to succeed, but that's not the case. You always will have a mixed bag. So that's why the portfolio creation is very important. And how do you, like, for example, if we are a fund, I'm just taking number, which is let's say have raised $100 million. How are we going to you know basically create the bouquet of deals? So out of that $100 million, are we going to allocate 60% of the money, which is 60 million, to Series A deals, which means each deal would be $5 to $6 million. And then would we do seed investment, so we can park another $10 million for seed investment, and rest of the money we can keep for follow on, because it is important that you support your own company. So that's how you create a portfolio. Um, and the portfolio will then have within them, what kind of sectors do you want to focus on. For example, for us, the new tech is very important, which includes AI, robotics, and also um, life sciences, right, which is becoming very interesting. And then we also have education businesses. We also have consumer businesses, which includes, assets like Bluestone, Clovia, etc. Biryani by Kilo, which is a biryani brand, so it sells biryani. So that diversification of portfolio helps you uh, to go through various cycles, because in the venture fund, each venture fund has to return money in 8 to 10 years. Um, so during that 10-year period, there will be many cycles, right? The market is going to go through a up cycle, a down cycle, and if you have a diversified portfolio, then you can sustain those cycles. Because if you are just invested in one kind of sectors, let's say you are just doing AI investments, and suddenly you have a big threat from the big fangs, the Googles, the Facebook. They come up with some very innovative sort of AI tool, and suddenly all your portfolio companies can die. So therefore, we take approach, or a lot of venture funds take approach where they have diversified portfolios, so they are de-risking themselves from just one kind of investments, right? And risk mitigation techniques are also used. Actually, the real work starts um, when you have already invested the money, because that's when you start working with the founders. That's where you start working with the team of those founders um, to guide them and make them understand what's happening in the market, help them with fundraising, navigate their businesses to greater lengths. Um, so the portfolio management is almost equally important as investment itself, right? Because now you have selected the area you want to invest in. You have selected the founders that you like. You have made the investment. Now you have to ensure that the investments are successful, and that's where a lot of heavy lifting and work is done, which includes like board meetings, which includes working with the founders on almost daily basis. So I sit on several boards, and it is the work is endless, because you are always consulting these founders about various things. Then they keep on asking you of various connections, you know so it becomes like your job to help them navigate through all of this, right? So the risk mitigation is when you work, there's a team of people, analysts, associates, etc., who also work with these people to ensure that they are doing the right thing. They are not burning too much money. They are following, the business plan that they have told to us, right? Um, and that's the way you mitigate your risk, because the more involved investor you are, the more you're working with them, the more you will know of the business and how they're performing, and you will help them to navigate through various things. And this includes market dynamics, this includes regulatory challenges, this includes um, various hurdles that they might have. This includes even helping them with their hiring, helping them fundraise, helping them with the just being sometimes just being listening to the founders, because founders go through a lot of problem. You almost feel like you're a psychologist, and trying to understand what they're saying. So it requires a lot of work. And if you're doing seed stage deals, then it requires even more work. If you're doing Series B deals, then most of the founders are mature, so they understand what they're doing. So there's a different kind of challenges. But VC business is a difficult business because you have to manage a lot of things, and their success is your success. So you're like a coach, and you want your team to win, right? So that's what it is. Yeah. So the risk mitigation is largely how involved you are with that portfolio, how much you know that portfolio, how much you yourself understand that industry, right? Because if you understand the industry, you can add a lot of value to the portfolio company. Next is several KPIs we use to evaluate investments. So this is a very important question, and I think the success of an investment also depends on this. While at the evaluation phase, there are various businesses, and various businesses have various KPIs. So are you doing a B2B business? Are you doing B2C business? Are you doing SaaS business? Are you doing deep tech business? uh, First of all, you have to classify, are you doing business to government business? So you have to first in your mind bucket what the startup is doing. And then once you have bucketed that, then you basically have different KPIs, and our team is divided in different formats. There are certain people who look at consumer businesses, D2C businesses. There are certain team who looks at deep tech businesses. There's a certain team who is looking at SaaS businesses. So it is important that there are various KPIs in these businesses that you evaluate in detail. For example, in consumer business, the unit economics becomes very important. The how much CAC, customer acquisition cost are you spending to acquire a customer, and what is the lifetime value of the customer, and what is their AOV, what is their return ratio, how much money they are making, or they're losing. All those, and most of the times, when we come into businesses, they're losing money, right? Because that's why they need venture capital. How fast can they grow? What's the team quality? All those things matter. So there's almost like a kind of a document that we have, where at the evaluation phase, these things are plugged into the KPIs we are tracking, right? And sometimes we look at a business and we don't invest. We say, okay, let's like keep it on the, let's look at it after 2 years or 3 years or year and a half, because maybe by that time they have improved the quality of the KPIs. And if the KPIs are not good and not strong enough, then we don't invest. And we also do a lot of customer calls. So in the customer calls, we identify what are some of the some of the key areas that we need to track. If they're selling consumer goods, then what is the satisfaction NPS score of customers? If they're in SaaS business, then what is the renewal rate? So there's, I mean, just this KPI alone, we can go forever. Kind of in fintech companies, there is a whole different set of KPIs. In a deep tech company, there's a different kind of KPI. So the investment professionals we have, they are tuned to kind of understand these, and compare them to best in class in the world, and come up with the best solutions. Follow on investment strategies in case of additional fund. Absolutely, I think every fund has to have follow on capital, because unfortunately founders are very optimistic people, right? And they will give you a business plan which they never meet. In my experience, there are two kind of founders: one who overachieve their business plan, and one who underachieve their business plan. I've never seen, most of the times, the founders were in these two buckets. I've never seen somebody really achieving their business plan as they said they would. So if they overachieve, it's a good news, because then they're doing better than what they said they would do. Um, but because being early stage and founders being overly optimistic, they always give a plan which is higher than what they can achieve, and that's why and that might be because it's taking time for business to find a product market fit. It's taking time for them to convert customers, so they thought they can convert customers much faster, but that's not happening. It is taking time for them to hire the team because they thought they could hire the team. Now they cannot suddenly hire the team, or it's taking longer time, and in the process they have burned too much money. So like I said, the portfolio management part, like there's a company without naming it, where they were shooting their budget expenses more than what we desired. So I immediately went to their office and I said, okay, let's open the books. Let's see where you're burning so much money. Let's see where we can reduce the cost. And are you really converting those people, who are coming to you, right? And even do you do all of this, and you want to support these companies because you're excited about these companies and you think they will do well. So that's where you need follow-on capital. Uh, so almost every fund in the world, I would say, keeps 20 to 30% of their fund size as follow-on capital. Some funds might even do more, right? And there could be also function of market. If the market is good, the fundraising environment is good, then you can raise a lot of capital. If the market is not good, fundraising environment is not good, it can take a long time to raise the next round of capital. So you have to be very sure about keeping the follow-on capital so that you can support your own companies, because once you are owning 25 to 30% of the company, it becomes your own company, right? Because you are now partners, and you have to ensure that you're supporting your own cause, right? So that becomes very important. So I think follow-on investment should be kept for good companies. You don't want to put bad money, behind good money, which means that you are actually supporting companies which are not doing well. So, but there are certain companies where they genuinely are doing well. It's taking time, so you need follow-on investment, right? So that's why most of the VC funds in the world have a certain allocation for follow-on investments. And the next thing is the concept of IPO. Okay. So in my career, IPOs are the best thing because they give exit to all the investors, and they are the hardest to come by because not every company is going to go IPO. In India, there are different set of rules. In America, there are different set of rules. IPOs are interesting because then the public, till the time you're in the venture capital environment, you're like a private, like you're in your own house where nobody from the outside world, like the public, is not allowed to see your numbers. So it's called a private company, and a private company valuation are done by the shareholders who are coming into the company. So there's a share price that is established, and every round, you keep building the share price, right? So that's the private valuation, right? And then the real test comes is when you want to open your company to the public, and you want public to buy or hold your shareholding. So when that happens, that's a real test. So you set up a price working with the investment banker to go to public, right? And when the banker establishes your price, uh, then you file papers with SEBI to say that I want to take my company public. There's a lot of diligence, and there's a lot of detailed work that happens on your company, on the numbers that you have stated, that they are true and honest. That people look at your board members, they look at their authenticity and how much they have worked. Um, So there's a lot of scrutiny that happens before the company goes public. Um, at IPO, a lot of a lot of shareholders at that point can offer their shares for sale. Problem with my computer, so I'm joining from my phone. Yeah, so we were talking about IPO process, right? So few go for IPO. There are, you know, so I had the pleasure of taking one of our company's IPO, um, and then you give their shares offer for sale, which is called the offer for sale when you're existing investor and you um, give the company for when it's going IPO, and then you can um, you know tell how much new money you are going to raise and how much of the old shareholding you want to sell. And this is where a lot of founders actually make a lot of money, because that's the time when they get liquidity in the IPOs. So IPO by itself is a massive concept, and you can literally spend like days understanding it. So I'm just giving you the gist of what IPO is. And Yeah, it's an event that every founder wants because it gives them money, it gives the shareholders money, and everybody goes happy. Role of merger and acquisition and exit strategy. So every investor also has to work on exit strategy because that's where you make money. Um, and That's where you actually go ahead and like a lot of Indian companies get um, their money back through strategic exits. So this can be through a big company acquiring you. Like for example, Lenskart has acquired many companies, PayU has acquired many companies, Paytm has acquired many companies, because there are um, certain the technology or product you can create which they may require, uh, and as they require that uh, as they require that and then the exit is provided to them. So the roles of merger and acquisition is really high for providing an exit, which is very much required in India. um, and There are many companies I have actually, when I know the company can't go IPO, then the best thing is for them to find a strategic buyer. So in my career, I have sold many companies where the M&A is the best route to go. So that's the role of an exit strategy. So it is, one second, I'm trying to join. I think the technology is failing me here. We need better technology. The Apple computer is like not working today for some reason. So the Apple phone is working, so I'm back on my Apple phone. So I think so. We spoke about IPOs, we spoke about M&A. So all these are like exit strategies, right? As the company grows, what exit strategy do you want to take? So there are two ways. One is go through IPO, or other one is take an exit through M&A, which is actually in India, M&A works really well because it takes a lot of time to companies to go IPO. So for example, one of IV Cap company, Clovia, was acquired by Reliance because they wanted to add the particular product they were selling into their portfolio. Um, Impact of liquidation preference and rights. Impact of liquidation. So every VC fund asks for liquidation preference, which means that, for example, if a company goes into liquidity, or it gets into a sale mode where they're not able to raise money, then what is the liquidation preference you have? So we have generally, like, let's say if I'm putting 30 crores into a company, I will take 2x liquidation preference, which means if there is an somebody who buys a company, I will get my money first. That's called the liquidation preference. Then somebody else getting the money. right? So that preference is because I am putting the money, right? I am helping you grow the business. So I don't want you to take your money and go away. So I first want my money back because I'm the investor. Um, and that's why it is important that I protect my money before you take your money, right? Um, so that's called the liquidation preference. And most VC fund take these rights. These are very standard rights, um, because we are managing somebody else's money, right? We are managing LP's money. So it is our duty that we give that money back to the LP. Um, so that's why we always take liquidation preference. Good practices for smooth transition of portfolio companies out of VC firm. Yeah, that's a good question. Like, so, once they have lived their life with us, the portfolio, we have helped them grow. They have done a good job. They are now in the process of, basically transitioning out in terms of, like Clovia, again, taking that example, the company was sold to Reliance. So, we sit down with the team, with Reliance, and we say, okay, listen, here's a, here's a company. It's almost like passing your child to someone else, in a way, because you want them to go with everything in a proper way so that they're finding a new home. They can, the company is still growing. Like the CEO is still the same CEO. Clovia CEO has now become a CEO in Reliance, and he's still running the company. So a smooth transition, or if you exit to some other fund, like to a larger fund, that's also a smooth transition, right? So that's also where you want to give them full disclosures of, what you know about the company, what you know about the founders, so that the buyer doesn't feel that, that we just sold them something which was really bad. They should feel that we have passed on something which is really good, and now they can help build that company. So that's what the smooth transition means. So I think what I spoke about is the portfolio management and exits. Um, for a fund, VC fund, there are three buckets. One is the deal evaluation. Well, first is the thesis building, then is the deal evaluation. Once you have figured out what are some of the industries you want to invest in, then you have your team aligned, then you have your thesis built. Thesis is built. Now you are going to, make your investments. Now you are going to manage those investments, nurturing those investments, and then you are going to go to exit. So that's the whole life cycle of a venture capital fund. A good venture capital fund should be very good in all these four aspects. And one more aspect I forgot is fundraising, right? Because that adds another dimension. So fundraising is not easy. It's basically going to people and saying that we are doing a great job, we need your money, and they are backing you. So the fundraising is another aspect which is very important to run a venture fund. And if you have good results, if you are given good exits, then obviously um, then more people will want to put money in you. If you have given bad returns, then not many people will want to give money to you. So it's all like a cycle, right? And some funds actually collapse in like one cycle, because if they're not done well, they will collapse. Some go on to do fund 3, fund 4, fund 5. It goes on, like the continuity of the funds goes on. It's a tough business. It's very difficult. It's not easy. Your mind is literally working 24/7, because and then you have to deal with the regulatory challenges. Government of India is very good in regulations, so they can come up with some regulation, you know, out of a blue, and then you have to figure out, okay, how do we navigate through that, you know? So that adds another dimension to the whole, running the VC fund. Yeah, but at the same time, it is very exciting. It is intellectually very stimulating job, because you are meeting some of the smartest people, who are
trying to change the way things are done. Booking a taxi was always happening, from many, many years, many, many before even I was born. But Uber came and said, okay, I'm going to make it, I'm going to disrupt this, right? I'm going to make this process very simple of booking a cab. And that was really the idea. And some venture fund, thought that, okay, this sounds very interesting. Let's try it out. And that's how Uber started and became a 70-80 billion dollar company. That's how most of the things start. Somebody, for example, also some of the things don't work, like WeWork, right? WeWork went to a crazy valuation, and then the business model does not seem right. They filed for bankruptcy. So, so we see business is the most riskiest business, and you need foresight, you need understanding, you need a lot of hard work to make the overall business successful. Yeah. So I think that's what I had. Uh, I kept it simple in very simple terms, so hope everybody can understand. And yeah, happy to answer any questions that you guys have.
Thank you, sir. If anyone have any question, please raise your hand, or you can also put it in the chat box. Hemant, you can unmute your mic and ask the question. Hemant.
Hello, sir. Heyman this side.
Okay.
Sir, I wanted to ask that you said that you also VCs also raise funds. So, what are some of the qualified investors in VCs, and if a fund like if a first time VC fund is being born, then how do you raise capital because you don't have any previous achievements to show that you have given good past returns to other investors?
Yeah, that's a very good question. I think the raising the first fund is the hardest. A lot of people, for example, work in funds initially to make a name for themselves, and are known in the market as good investors. Um, and people know them, that they have been doing this business for a while, they understand what they're doing. And the first set of money you raise is from your family and friends, plus, on base of your thesis, right? If you are doing, for example, if you understand something like what's your right to win, do you understand deep tech way better than anybody, in your class or whatever? If you do not have a track record, there are a lot of first time fund managers. They actually play on the network. Let's say you come from IIT Madras, there's a lot of deep tech happening there. You were part of the research that was going on there. You come out and say, listen, I have access to lots of founders which you can't have access to because I am sitting in that ecosystem. And normally the first funds are not that big because people don't trust you, so they say, okay, fine, okay, I like your story, I like what you're doing, I'll give you 20 lakhs, or minimum check size is 1 crore, by the way, to invest in VC firms. You have to go through the AIF structuring. So or let's say there's another example, A91. Those guys were very experienced guys, started the fund. They came with Sequoia background. They were in Sequoia for 10 years, and they raised $200 million fund, first fund, because they were very well known in the market, right? So, so I think it's a very hard one, but that's how people start. Or you take a position, and that people, the LPs, like. For example, you can say, okay, I'm only going to invest in women founders. So there's a fund called She Capital, where they have taken a position that I'm only going to do women founders. So some LPs are, and she used to run a company, so people
So, what is
know.
an LP?
LP is limited partner. LP is a rich person,
Okay.
can be anybody, can be a gutke wala. LP is the person who is going to put money in your VC fund. So LP can also be, banks. Like we have a lot of LPs in our portfolio, which are all the banks and institutions. So selling to institution and banks is much harder versus selling to individuals. So the HNI can be LP. Anybody who can invest 1 crore plus is an LP. You can also be an LP, if your parents are rich. So basically, LPs are the people who say that, I have evaluated these managers. I like their thesis. I love what they're doing, right? Let me invest in them, right? So we are almost like founders, right? So you're as founders, you're going and raising money, uh, because fund is also a founder fund, right? So or you can, or there's other fund which has taken a position, um, like for example, climate tech. There's a climate tech fund, so they're just going to do climate tech. And there are a lot of LPs in the world who care about, a lot of rich people in the world who care about climate tech, right? They want the climate to be better. So that's a position you can take. You can take a position of, I'm going to do a fund, just on, mobility, like EVs, mobilities. So then you people say, oh, they get excited. Okay, it's a mobility fund. Let's do that, right? So that's how you do it. Yeah. So yeah, first time is harder, and once you raise the first fund, then it becomes, what numbers have you delivered? Then it's a different game. It's like it doesn't end, because now it is even harder, because if you're not delivered the money back to your investors, then you will not be able to raise second fund, because everybody's going to say, oh well, you didn't do anything with that, you know 300 crore you raised, you've only returned 150 crores. That's not a great outcome, right? So then your first fund has to do very well for you to raise second fund. That's how it works.
And so, how do you check that the money that you have invested in startups that they are using for the same purpose that they are telling you to? Like, how do you check for whether they have showed you that much growth rate, and if that much growth rate is not achieved by them till that date that they have committed? So, how do you check on those parameters
Yeah,
that the
we get monthly MIS reports. uh, we also get, we I mean, like I said, I talk to these founders, my founders who I am managing, on almost daily, monthly, weekly level, right? But you hope they will do well, right? And that's why it becomes important that you put money in exceptional people, right? People who are, because doing business in India is not easy, so you have to put money behind people who are exceptional.
Thank you, sir.
Thank you, Hemant. So that's the next question by Ananya. She's asking, how do VCs who are new in the business acquire LPs?
Sorry, VCs who are new into business?
Acquire LPs.
You go through your network, um, and I mean, God opened doors, So basically, just it's like very simple. You just go and start knocking doors. It's like finding a job, no different than finding anything in your life, right? So a lot of hard work and convincing people that you're the best manager out there, and just making it happen. There's no easy answer to this. It's hit and trial. Go to your parents, all the rich friends. That's a starting point.
Networking, basically.
uh, okay.
All right, sir. That's the next question by Abhidwe. So we get to hear this a lot on LinkedIn nowadays that any startup with an .ai domain gets investment easily from VCs. So how true is that from a VC context?
No, it's not true. I think rather for me it's a negative. I mean, when I say .ai, I'm concerned. Is it just for the namesake, or is it that they're really doing something in AI? And you're right. I mean, a lot of people will just use this opportunity, which is also smart, like because like I said, founders are always selling, right? They say that they have the best product, so you can't tell them that, oh, don't do this because this is a hot thing, this is selling. So they will use it. As an investor, it's your that's where the investor are cynical, like I said, because I assume everything is wrong, right, till you prove it right. So so that's the way you have to operate. And some investors, I'm telling you today, will get into the frenzy of AI and make mistakes, uh, so you have to kind of keep that in your mind. And Indian founders and typical Indian people typically are very good salespeople, right? They know how to, what's the next, what's the best buzzword, and they will go behind it, right? We are great salespeople, so we have to figure out, uh, what's good and what's bad.
So do VCs usually pre-plan their exit strategy? Like, for example, if they are investing in an X company, do they think like, okay, if I achieve 10x, I'll exit from this, or is it more like, okay, I have invested in this X company for over 10 years, I don't see anywhere going up from here, so I'm exiting. Is it
No,
more
no,
like
no.
that?
They plan. We plan a lot, um, and we should, and it's very dynamic. Certain time it's not good to exit, because if the company is performing very well and the upside, then you're leaving the upside, because there will be a lot of upside that might get built, and you exited one. So for example, if I would have exited like my previous fund companies in 2020, that would have been very wrong, because 21 was a year where, so VC industry is investment in VC industry is also very dynamic. You have to make decisions based on market. um, there's a lot of things at play. Yeah, so there's always something happening, right? But like I said, this is, if you want your brain to work 24/7, you should come to VC industry. So yeah, so it's not a, you do invest thinking that you want to exit in a particular fashion, but things not always go in the same way. So you have to, you know course correct when things are going in different direction.
Thank you, sir. And you said that diversification is like one way to minimize risk, but then there are many VCs that, as you said, only invest in a particular sector like climate tech or like in sustainability or in deep tech. So it's like, how do that VCs, what kind of de-risking mechanism do they have?
What kind of what? Sorry.
De-risking mechanism, like
De-risking
how?
is, I think, uh, there's a saying which says ride your winners and cut your losses, right? It is always good to do a portfolio review, which we have today, by the way, for our fund, to see, where are the what are the things you don't want to continue, what are the things you want to continue, and kind of, and also, in a fund there is a principal amount and there is alpha, right? So principal amount is, like, let's say you have raised 100 million fund. So what you want to do is, you know get the principal back, and after that you are then safe, right? Then it's gravy left. Even if you do mistakes, you'll still be okay. But try to get your principal back as soon as you can, because once your principal is back, your headache is gone कि मैंने principal return कर दिया, right? It's like sometimes, I don't know how many of you play poker, right? So
if you're betting with money in poker, right? Some it's greed and fear, right? You keep if you're winning and then you still say, okay, I want to win more, and in certain cases you can lose, in certain cases you can win more. So, but I think in case of a VC fund, it is important that you keep your eye on exits, return your um, principal amount first, and then the alpha.
And you said that like IPOs make VCs happy, but in cases like Mamaearth, who like withhold their IPOs or postpone it. So from a VC perspective, how do they see that?
Sorry, in case of who?
Mamaearth,
Mama Earth. Yeah, what about it?
like they postpone their IPO, they withhold it due to certain market conditions.
Ha
They
ha.
weren't ready.
Yeah, but they did go IPO now, right?
Yeah, but like you said that, like if you're invested in a company
Yeah,
and
but
that company goes for
time.
IPO and then they're postponing it.
Yeah, timing is everything, right? So if they would have, because the last year was really bad, right? Because of the startup valuations were going down, etc., etc. So now was the right time, and even some of my companies, Exigo, for example, they also postponed their IPO. Uh, I mean that was previous fund. I already took my exit, but they were supposed to go to IPO, and they also had to delay because the market is not going to reward you. I mean, market is good, and Mama Earth IPO was also decent. Delivery was another IPO I was involved in, which just happened at the end of the cycle. You have to catch the right cycle for a good IPO, because the
So it's like,
market is
so,
like, it's like, when you have to get the right ball to hit the six, right? It's the same thing. You have to catch the market has to be growing, and people need to be, okay, I believe in this sector, I believe in this company, I believe in these founders. Let's do it, right? um, so that's why the reputation becomes very important.
so like is postponing an IPO seen as a like bad sign or anything like that?
Is IPO seen as a bad sign?
Postponing the IPO.
um, it's not bad, it's actually wise, because if there's no reason for a company to go IPO, right? Unless required, right? So if I am the founder of the company, I want maximum returns, right, for my shareholders. So I should find the right time. So if you have filed and you're backing out, then it's seen like, okay, matlab, you're not ready, right? But if the time is not ready, and as a founder you took a call that you don't want to go IPO, that's actually okay, because that is wise enough for you to understand that I don't want to. It's like a lot of companies will come to me and say invest, invest, invest. I don't. I want to take a call when I feel I am convinced, right? Because I am married to that company for 7 years or 8 years, right? So I don't see it as a bad sign. It's actually good.
Thank you,
Yeah.
sir.
Thank you.
That's it. Next question from Ananya. She's asking,
Okay,
sir,
and
would you
maybe it's
please?
last question, because then I have to go for a meeting.
Okay, yeah, sure. Uh, she's asking, sir, would you please share your journey in your career as an investor till now?
Can you what?
Can you share your journey in your career as an investor till now?
Yeah, as an investor till now, it has been. Yeah, I've been investing in India since 2010, and it has been a fascinating journey, very interesting, and things have changed and evolved a lot. In 2010, you would see very few founders. Now you see founder in you know, everywhere, right? From Kerala to Kanyakumari, to like Kashmir, so it's a very different ball game. Lot many deal flows, lot many funds as well, and the founder quality has also improved. I'm glad to see that you guys are asking such good questions, actually. which was not the case in 4 or 5 years or maybe 7 years ago. Um, as an investor, your neck is always on the line, and honestly, I'm telling you, there are more mistakes that you can avoid is better. Um, for me, I don't. I'm very conservative investor. I don't, uh, do aggressive investing unless it's my own money, which is like angel money, which I can then invest much faster. I like, and also things keep changing and evolving in an investment journey, right? There was a lot of B2C transaction businesses in 2010, because travel was big. That was the journey, and now it is more deep tech, AI. So you as an investor also have to keep on learning. Fintech is big, so your learning is never ending, right? So as an investor, you are always vulnerable because what's the next big thing, right? And you have to keep pushing your limits and your understanding. A lot of collaboration. I think India is the right market, because next 10 years are going to be really amazing. You just have to keep at it and keep doing the right investments and hope they work. As my investment journey, I think I don't know enough, to be honest. I keep learning every day, and I enjoy this journey. But I want to be an investor till I die, I think, because this is one job which will keep you excited all the time. There will never be a dull moment. I'm still in the learning process. I always will be, I think. It's a very fulfilling journey as well when you see the companies like Flipkart was a great success story. Delivery for me personally was a great success story. Ixigo is going to go IPO. It's going to be a great success story. Some of the IV cap investments like Bluestone, Biryani by Kilo, Miko are going to be like great success stories. So as an investor, it's not even about the money. It's about seeing your companies go places. That's what gives you the satisfaction, I think. Yeah.
All right. So this
Okay.
concludes our venture capital bootcamp session. I would like to express my sincere gratitude to our guest speaker Tej Kapoor for sharing his valuable insights, and thank you so much for your time and generosity. We really appreciate your support and guidance. I would also like
Thank
to thank for all the participants for joining in the venture capital. It's been a pleasure interacting with you all. Lastly, I want to invite everyone to stay tuned with ESL IIT for more exciting events and opportunities. And if you're interested in VCs or startup space, then there are a bunch of startup strategy lined up for the summit. Do check that out. That's all. Thank you and goodbye.
thank you so much. Bye. Good luck.